Okay. So, good afternoon, students. We are back again in the revisionary lecture of investment decisions. I hope you have learned and understood the concepts of investment decisions, different capital budgeting techniques in your regular batch of LVCs. So, let's just revise that stuff today. Okay? Let's just revise that. So today I would be writing everything on the Word document as my pen has stopped working right now. So we would be solving everything in the Word file. So let me share the screen. Yes, my screen is visible, right? My screen is visible to you all, friends? Yes, okay, it is visible. Okay. So what is the ultimate objective of investment decision? Tell me. What is the ultimate objective of investment decision? What have you studied in your regular batch? Can you please tell me, friends? What is the ultimate objective of investment decisions? Can I say in this chapter, the objective is very simple. The objective is whether to accept the project or not. Whether to accept the project or not. Correct? This is the ultimate objective of this chapter, whether to accept the project or not. So, what do you mean by project? Let's first understand that term. What do you mean by the term project? Project under investment decision has a very broad meaning. Has a very broad meaning. Here we are not talking about your school college ka project. It has a very broad meaning. Let's say, for example, if I want to start a new business. So whether to start a business or not, that is a project. That is an investment decision. Let's say my company wants to launch a new product in the market. So whether to launch the product or not, that is also a project. And that is also an investment decision to be taken. I am currently doing my manufacturing process with machine X. Now machine X has become an obsolete. So whether to replace machine X with new machine or not, that is also a project. That is also a project. So that is also investment decision. Are you getting this? Is everyone following? What do you mean by project? Project has a very broad meaning. It has a very broad meaning. Currently, I am selling out something on scrap. See, my manufacturing process generates some scrap. I'm selling out vendor at some predetermined price. Now, through research, it has been found that this scrap can be processed further and can be launched as a new marketable product. But to launch as a new marketable product, we would need to buy certain machineries. We would need to set up certain infrastructures. So whether to set up the machines and infrastructure or not, that is also a project. That is also an investment decision. Hope everyone is following. Students, are you clear? The ultimate objective of this chapter is very simple. क्या हमें प्रोजेक्ट लेना चाहिए या नहीं लेना चाहिए, उसका डिसीजन मेकिंग इज इन्वेस्टमेंट डिसीजन. ठीक है? अंडरस्टूड? एंड इन्वेस्टमेंट डिसीजन इन्वॉल्व्स कंपैरिजन ऑफ कैश इनफ्लोज विद कैश आउटफ्लोज, but not in absolute terms. We have to compare cash inflows and cash outflows in relative terms. So investment decision says that you have to compare cash inflows and cash outflows in relative terms and then decide whether to accept the project or not. Now, what do you mean by relative terms? Everyone would be having this question ki relative terms matlab kya? What do you mean by comparing cash inflows and outflows in relative terms? Bolo. Anyone? Can anyone share? Or can anyone help me in explaining what do you mean by relative terms? Or what do you mean by relative comparison? You can try. You may be wrong, that's okay, but at least give a try. At least give a shot. I am not getting any response. Don't know. Okay. Don't know. वो भी एक आंसर है. Correct. That is also an answer. You don't know. Present value. Yes, correct. Shoaib is correct. Relative comparison means comparing the present value of cash inflow, PVCI, with PVCO, present value of outflow. Focus on the word present value. Present value जहां जहां हम बात करते हैं, wherever we talk about present value, it is all about time value of money. Understood? We discount the future values. We discount the future cash flows at a discounting rate. And then we get present value. So under investment decision, or I would say under capital budgeting, we compare present value of inflow with present value of outflow. And if net present value is positive, we accept the project. And if net present value is negative, it means present value of outflow is more than present value of inflow. So we reject the project. Understood? So investment decision is all about accepting or rejecting the project. It is all about decision making. Decision making depends on comparing the inflows and outflows. Project से कितना आया, project से कितना गया. And not just in absolute terms. We need to compare inflows and outflows in relative terms. And relative term means comparing present value of inflows with outflow and then decide. Okay? So to make investment decisions, we know that there are different techniques. We know that there are 7 different techniques available to decide whether to accept a project or not. Which are those techniques? Chalo, let's name one by one. Let's name one by one. Bolo, which are those techniques? I'm waiting for your response. No one is responding. Payback period method. ARR, correct. So first is payback period. With payback period will come discounted payback period. Payback period, then discounted payback period. Then accounting rate of return or average rate of return. Fourth, NPV technique. Fifth, profitability index. I hope you are familiar with all these terms. Profitability index. Sixth, IRR. Seventh, MIRR, modified internal rate of return. Correct? These are the 7 techniques that we need to learn or that you have already learned in your regular batches. Yes or no? Yes, MIRR. Correct. Profitability index. Yes, PI, IRR, NPV. Yes, correct. So let's quickly revise every single technique one by one. Okay? First is payback period, and in short, payback period is denoted by PBP. This is the short terminology of denoting payback period. So what do you mean by payback period? Payback period means the time within which my original reinvestment or original cost or initial investment is getting recovered. Time within which my original investment is getting recovered. Original cost of the project is getting recovered. Okay? This is the meaning of payback period. Let's say I have invested in a project. My initial investment in the project is 5 lakh rupees. So within how many years or how much time it will take to recover this 5 lakh, whether 2 years, 3 years, 4 years, how much time it will take to recover or to recoup back this 5 lakh is called payback period. So if it takes 3 years for the project to recover this initial investment, then 3 years is your payback period. If it takes 5 years, then 5 years is your payback period. So paying back the initial investment or recovering back the initial investment is payback period. ठीक है? इसमें हमने क्या देखा था? What did we saw here? If the cash flows are constant, if cash inflows are constant every year, then there was a simple formula to calculate payback period. What was the formula? It was nothing but original investment divided by annual cash flows. Divided by annual cash flows. Okay, this was the formula. Let's say original investment is 5 lakh. Let's say original investment is 5 lakh. The project is for 5 years. And every year my annual cash inflows, is 2,50,000 rupees. So original investment 5 lakh, project life 5 years. Every year my cash inflows per annum is 2,50,000. So can I say my payback period would be 2 years? Within 2 years, I would be recovering back my original investment amount of 5 lakh. Yes or no? Are you getting this? Is everyone following? At least respond yes or no. Okay? If you are not getting, then you can respond, sir, please explain again. Or sir, come back again. Okay? So when the cash inflows per annum are constant, in that case, the formula of payback period is just dividing the annual cash inflows to original investment. But what if the cash inflows are uneven? What if every year the cash inflows are not constant? Uneven cash flows. So in that case, we used to prepare a table of cumulative cash flows and then we used to do interpolation. Hope everyone remembers this. We used to prepare a column for cumulative cash flows and then using the interpolation technique we used to decide the payback period. Okay? So during uneven cash flows, you need to prepare cumulative cash inflow का table and by interpolation you used to find the payback period. Okay? So this is what we have learned, or this is what you have learned, correct? Now there are certain disadvantages of payback period. There are certain disadvantages of this technique. What is that? Payback period ignored the time value of money. Means let's say annual cash flows, project life is 5 years, annual cash inflows per annum is 2,50,000 per year. Okay? Life is 5 years, annual cash inflows per year is 250. So it means the cash inflow at the end of year fifth year के बाद 250 जो मिलेगा ना, it is worth 250 today only. This is what it means, because it ignored time value of money. That cash inflow of 250 which is generated at the end of fifth year is worth 250 only today. This is what ignorance of time value of money means. Are you getting this? So payback period, ignore time value of money. Let's say if the cash inflows at the end of 10th year is 20 lakhs, so it means the cash inflows that would be generated in future of 20 lakhs at the end of 10th year is worth 20 lakhs today also. This is what it means when time value of money is ignored. So can I say this is one of the deficiency of payback period, because it ignored time value of money? And one more disadvantage of this method was that all the cash inflows after payback period, let's say my payback period comes to 3 years. So all the cash inflows that are generated after this point of 3 years are ignored. Are you getting this? So it is quite possible, likely possible, that majority or substantial amount of cash flows would be after payback period, but it ignores or it ignores to give importance to such cash inflows after the payback period. So these were the disadvantages of payback period that you have learned. To overcome the deficiency or to solve the problem of time value of money, we have another technique called discounted payback period. I hope everyone is understanding. I hope everyone is understanding. I will try to solve as much problems as possible. We still have one more revision lecture of investment decision. So if it gets covered, well and good, but I will try to cover majority or maximum all the practical problems. Okay? So the disadvantage of payback period, number one, ignores time value of money. Number two, ignores cash flows generated after payback period. These are the two basic disadvantage of payback period. Okay? To solve the problem of this first disadvantage, to solve the problem of time value of money, we have another technique called discounted payback period. Which is the another technique? Discounted payback period. So again, the process remains same. The difference is that instead of taking the absolute amount of cash inflows, under discounted payback period, we take present value of cash inflows. Are you understanding? The only difference between payback and discounted payback is under discounted payback period technique, you take present value of cash inflows rather than absolute amount. Understood? Take PVCI rather than absolute amount. And then again the process remains same. You then prepare the cumulative cash inflows ka column and then do interpolation to calculate discounted payback period. But the only difference why discounted payback period technique is there, it is there just to solve the problem of payback period which ignored time value of money. Okay? Now my question to you, Bolo. Let me ask you one question and I want you all to reply. Payback period will be higher than discounted payback period, or discounted payback period will always be higher than payback period? Tell me, students. Will discounted payback period be higher than payback period, or payback period will always be higher than discounted payback period? What is your opinion? What are your thoughts? Tell me. Discounted payback period will be higher. Correct. Why discounted payback period will be higher? Can I see we are calculating present value of those future cash flows? So obviously present value will be less than future value. Are you getting this? So present value of cash inflows being less than future value. Can I say it will take more time to recover the original investment? So always discounted payback period will be higher than payback period. Why? Simple reason is we discount the future cash flows. So discounting will always reduce your cash inflows ka value, and lower the cash inflows ka value, more the time to recover original investment. Understood? So this can be asked in MCQs. That's why I'm discussing these points with you all. Correct? So this is what you have studied. Then third techniques. This was first, number one. Discounted payback period, number two. Then we have third technique called ARR, accounting rate of return or average rate of return. It is called as accounting rate of return, book rate of return, or average rate of return. See, focus on the word. This technique focuses on the word accounting. So here, instead of giving significance to cash flows, it gives significance to accounting profit. It gives significance to accounting profit. Are you getting this? Instead of, see, all the other techniques gives focus or gives significance to cash flows. But this technique, this is the only technique that gives significance to accounting profit. So the formula to calculate ARR was very simple. You take average of net income of all the years, divide by either original investment or average investment. This was the formula, correct? This is what you have learned in accounting rate of return. It is nothing but average net income, average net income, not cash flows. Please focus on the word income. Here it is not cash flows. It is net income, means depreciation that we used to exclude in calculating cash inflows are included here. The only difference is this: all the non-cash expenses forms part of ARR, but it does not form part of cash flows. Are you getting this? Divide by either you do by original investment or average investment. This was the formula to calculate ARR. Okay? Any queries till now, friends? We will solve some practical problems, and in that it will be very clear to you all. But as of now, okay, Srini has a question of payback reciprocal. Payback reciprocal. See, focus on the word reciprocal. So it is just opposite of payback period. Just exactly opposite of payback period. But there are certain conditions to calculate payback reciprocal. Payback reciprocal method says that first condition is cash inflow should always be constant. Only then we can be solving, only then we will be able to calculate payback reciprocal. And the life of the project should almost be equal to double the payback period. These are the two conditions of payback reciprocal. So payback reciprocal is just opposite of payback period. So can I say the formula would be annual cash inflows divided by original investment. Divided by original investment. See, what is the formula of payback period? Original investment divided by annual cash inflows. So here the formula reciprocal means ulta. Formula would be annual cash inflows divided by original investment. But payback reciprocal says that I have my two conditions. One is annual cash inflows per annum should be constant. Only then it will be able to, only then you will be able to calculate payback reciprocal. And the life of the project should be almost double the payback period. So what payback reciprocal denotes, what does it gives you? It gives you rough idea about the IRR rate. It gives you very rough estimate or close estimate to IRR. But the condition is that annual cash inflows per annum needs to be constant. Only then you can solve. Okay, so that is payback reciprocal. Sir, when Shoaib has a question, when to use original and average investment? See, Shoaib, it depends on you. It is your personal choice. The only fact that you need to consider is you need to write down the note in your solution. If you are using original investment as a denominator, then you should mention a note about it. If you are taking average investment as a denominator, then also you need to mention the note about it. So whichever method you choose, it is correct. Answer would be different under both the methods. But mentioning a note about the same is very important. Okay? So please mention the note whichever method you follow. Fourth technique, our favorite technique or highly asked technique, NPV, net present value technique. So what is the formula of net present value? Can I say it is nothing but present value of cash inflows less present value of cash outflows? Correct? Correct. This is the basic formula or the bird's eye view of net present value technique. Yes or no? How to calculate cash inflows? How to calculate cash inflows? So we know the format. The format is sales, start with sales, less variable cost. Correct? Yes or no? Will give me contribution less fixed cost but excluding depreciation. So the resultant figure will be called as net profit before depreciation and tax. Correct? From this value, from NPBDT, we will subtract depreciation. So the resultant amount is called net profit before tax. From NPBT, we will subtract tax. So the resultant figure is called NPAT, net profit after tax or earnings after tax. And again we add back depreciation. Why? Because it is a non-cash expense. The resultant amount is called cash inflows after tax. I hope you remember this format. I hope you remember. Now you would have some question like, sir, why we are subtracting depreciation first and then we are adding back? अगर minus करके add ही करना है, if you wanted to add back, then why did you subtract? This is the question that everyone would get. Yes, Om Krishna is right. That depreciation is a non-cash expense, correct? It has no relevance in cash flows as far as depreciation is concerned. But due to presence of depreciation, there would be certain tax savings. Yes or no? There would be certain tax savings because of depreciation expenses. Our company would save some tax, which is called as tax shield. So depreciation is not a cash inflow, but tax shield on depreciation is relevant for our calculation, and that is a cash inflow. So that's why we subtract depreciation first, so that we can correctly calculate the tax amount over here. And then since depreciation is irrelevant for our cash inflows, we add it back. This is the logic. Tax shield on depreciation is relevant. Depreciation is not relevant. Okay? Now my next question to you. So sir, why didn't you subtract interest and preference dividend? The format of income statement that we have learned in ratios, that we have learned in leverages, that we have learned in capital structure. The format was something like this: EBIT less interest, EBT less tax, EAT less preference dividend. So why didn't you subtract interest and preference dividend over here? This should be your question. Yes or no? Well, what is the reason that I haven't subtracted interest and preference dividend over here? Can any student try? What could be the reason that why interest and preference dividend is not subtracted from the income statement? I'm waiting for your responses. You may consider. Yes, Sukena is absolutely right. See, the cash inflows that we have calculated here will be discounted using a discounting rate. Yes or no? And what is our discounting rate? What was our discounting rate? Our discounting rate is nothing but KO, cost of capital, or I would say WACC. So can I say under WACC, interest, preference dividend, equity dividend, everything is covered? Yes or no? What is the formula of WACC? It is nothing but weight of debt multiplied by cost of debt. So in that cost of debt, our interest is getting covered. What is plus we add weight of preference shares multiplied by cost of preference shares. So what is cost of preference shares? Can I say it is nothing but preference dividend? So those costs are already included in my cost of capital, in my WACC. So again, if I take here in this statement or in this income format, then it would be double deduction of interest and preference dividend. So that's why we ignore in this format, in the format of calculating cash flows after tax. Okay? Everyone understood this? Why it is ignored? Correct? Okay. Now, there are certain specific pointers under NPV technique that we need to take care. That is to be taken care of. What are those specific pointers? Number one is on sunk cost. When I say sunk cost, is the cost that has already been incurred by the company. Whether you take the project or not, sunk cost has been incurred. Sunk cost means वो पैसा आपका डूब गया. Whether you take the project or not, your cost has already been incurred. So it is irrelevant for our cash flow consideration. Are you getting this? Sunk cost. Let's say to undertake a feasibility study, I hired a professional and paid professional fees for preparing a project report. Okay? I wanted, like, there are certain projects which I feel are lucrative for the company to be undertaken. So for that, I hired a professional. I told him to prepare a project report for all the projects under consideration. So he prepared a project report for me. Obviously, he will not prepare it for free. He will charge certain professional fees from my side. So whether now I take those projects or not, I have to pay the fees to the professional. Yes or no? I cannot say, no, I am not taking the projects, so I will not pay your fees. So that professional fees is a sunk cost. Whether you take up the project or not, वो पैसा डूब गया. That money is gone from your pocket. That money has sunk from your pocket. So sunk costs are irrelevant. Similarly, allocated common cost or allocated common expenses are again irrelevant for our cash flow considerations. Okay? Common costs are actually been apportioned to different businesses and different projects. Okay? So by taking a new project, there would not be any increase in common cost. It is just that apportionment proportion would differ. Hope you are understanding. And I hope you have learned this. Common cost means the cost that is attributable to all the projects. Now, if I take some new projects, this common cost would not increase. It would remain the same. Just the proportion of allocation would differ. Are you getting this? So allocated common costs are also irrelevant. Yes, if I take a new project and my common cost increases due to that project, then it is relevant for our decision making. Then it is to be considered. Hope you are understanding the difference between the two. Are you getting this? By taking the project, if common cost increases, then up to such extent, it is relevant for our decision making and we will take that. Any queries till here? We are currently quickly revising the specific pointers to be considered while calculating cash flows. So one is sunk cost. Sunk cost is to be ignored. Allocated common cost again to be ignored unless it increases by taking up the project. So this is number 2. Third is about working capital. Bolo, working capital. Can I say working capital is the funds required to run day-to-day business operations? Yes or no? Let's say I want to start a new manufacturing business. So I've purchased a factory land. I've constructed a factory building on the factory land. I have bought all the machineries. I have set up all the electrical fittings. I have constructed my office space as well inside the factory. So now tell me, by setting up all this infrastructure, or in other words, by setting up all these fixed assets, will my manufacturing business start? Will my manufacturing business start just by setting up or just by buying these fixed assets? Obviously not. To run these fixed assets or to run, let's say to run the machine, we need to enter raw materials. So we would need raw materials. We would need some labor to work on those raw materials. We would need some daily routine expenses, overheads. So can I say that is the funds that you need for day-to-day business, which is nothing but working capital. So whenever you start with a project, it is not just the capital investment that you need. you also need working capital. So can I say working capital is a cash outflow at the beginning of the year, correct? At the beginning of the year and as and when needed in the future as well. But once the project ends, once the project life ends, can I say this working capital will be released back to my company? Yes or no? So that release of working capital is considered as an inflow. Release of working capital is cash inflow. But this release will happen at the end of the project life. Okay? So it will be at the end of life. I hope you are understanding what I'm trying to say. What do you mean by release of working capital? See, working capital is nothing but amount that is blocked in your debtors, that is blocked in cash, that is blocked in inventory, correct? So once the project is completed, can I say debtors would pay back the money to you? Cash bank balance would get ultimately transferred to the company. So everything would be released back to you. So that release of working capital is an inflow at the end of the life. Understood? Any queries here? No working capital is required. No working capital is required. No, you need working capital. Or I understand you are trying to say, no, sir, working capital is required. I assume you are trying to say this way. So understood, this is all about release of working capital. Are you getting this? Then there are certain other specific pointers as well that we will see in practical problems at that point in time. Right now, if I discuss, you will not understand that much properly. So it is better to understand at that respective point in time. Then under NPV technique, we also learned about incremental approach or calculating incremental cash flows. What do you mean by incremental cash flows? It is nothing but the additional benefit. You just consider the additional benefit or additional cost for deciding whether to invest or not, or for deciding whether to accept the project or not. So let's say there is an old machine and now you want to replace the old machine with new machine. Okay? So can I say this is a project and we need to decide whether to replace the old machine or not? So what additional benefit and additional cost new machine brings with it? That is incremental cash flows. Are you understanding what do you mean by incremental analysis or what do you mean by incremental cash flows? The new machine, what additional benefits or additional cost the new machine brings with it? We need to just focus on that. Understood? So that is incremental approach or incremental cash flows. Then fourth technique was very simple. It is called as profitability index, or the other name of this technique is desirability factor. Yes or no? Once you are able to calculate NPV, PI is also very simple. It is nothing but PVCI divided by PVCO. NPV is PVCI less PVCO, whereas profitability index is PVCI divided by PVCO. Now, how to interpret profitability index? So again, we learned that profitability index is, or it denotes how much cash inflows is generated by 1 rupee of investment in my outflow. Are you getting this? How much cash inflows, but in present value terms. How much cash inflows is generated by 1 rupee of investment in outflow, but in present value terms. So if my profitability index, let's say it comes to 1.5:1. Let's say it comes to 1.5:1. So 1 rupee of investment in the project is generating 1.5 rupee of cash inflows, but in present value terms, not in absolute terms. So this is how you interpret profitability index. Are you getting this? Any query in profitability index? Sorry, this was our fifth technique. First was payback period. Second was discounted payback period. Third, we discussed about ARR. Fourth, NPV. Fifth is profitability index. Bolo, any queries here? NPV, see, we calculate for NPV, calculate present value of inflows only, na? And not outflows. Sir, how will be treated a government grant? So government grant, Shoaib has a question, sir, how government grant for setting up a machine will be treated? So can I say government grant will reduce your cost of machinery? Let's say your machine cost is 2 lakh, but out of this 2 lakh, government provide you 50,000. Correct? So as far as company is concerned, company ka cost is just 150. Are you getting this? So you have to provide depreciation on 150 only. You have to provide depreciation on 150 only. Correct? So this is profitability index. This was number 5. Then sixth was IRR. Sixth technique was IRR. What do you mean by IRR? IRR. Under IRR technique, we used to calculate the discounting rate where PVCI is equal to PVCO. Are you getting this? हम क्या करते थे? We used to calculate the rate. Now we are not calculating any amount under IRR. We used to calculate the discounting rate where PVCI. It is the discounting rate where PVCI equals to PVCO. Are you getting this? In other words, can I say it is that rate where NPV is 0? Because NPV can be 0 only when PVCI is equal to PVCO. Only when PVCI is same as PVCO, only then NPV can be 0. So IRR is that discounting rate where PVCI is equal to PVCO. Or in other words, where NPV is equal to 0. So how did we calculate IRR? We used to follow trial and error method. First, we used to calculate NPV at, let's say, at 10% rate. And if at 10% NPV is positive, then we used to jump to another trial at 15%. So under 15%, let's say NPV comes negative. At 10% it is positive. At 15% it comes negative. Then now it is for sure that it lies between 10 and 15%. Then by applying the formula of IRR or by interpolation, we used to calculate the IRR. So what is the formula that you have learned for IRR? It is nothing but lower rate plus NPV at lower rate divided by NPV at lower rate less NPV at higher rate, the whole multiply by higher rate less lower rate. Yes or no? This is the formula to calculate IRR, and the formula is derived from the logic of interpolation that you have already learned. Understood? So this is IRR technique. It is the discounting rate where NPV is 0, or in other words, where PVCI is equal to PVCO. And to calculate IRR, use interpolation method and use trial and error method. First, use trial and error method, and then based on that, do interpolation. Whether to take present value of grants. Now it depends when the grant is received. If it is received at the beginning of the year, generally what happens whenever you undertake a project, within few months you receive a grant. So it is at the beginning of the project only. Means it is at year 0 only. So you directly subtract from the initial investment. Understood? So directly subtracted from the initial investment. Generally grants are received very, very like at a very instant stage. Once you have bought a machinery, you make an application to the government and government will send you or will credit the grant to your account. ठीक है. So बातों बातों में we have learned IRR technique as well, not learned but quickly revised IRR technique. The last technique of capital budgeting is modified IRR. What is the difference between IRR and modified IRR? What is the difference between IRR and modified IRR? See, there was one standard assumption of IRR. IRR technique assumes that all the reinvestment of cash inflows, happens at IRR rate. And what do you mean by IRR rate? IRR rate denotes the maximum earning capacity of the project. If you want to remember what is IRR, then you have to remember like IRR is nothing but the maximum earning capacity of the project or maximum efficiency of the project. What is the maximum rate that project can generate? That is IRR. So IRR has a assumption, or I would say a disadvantage, that it assumes all the cash inflows are reinvested at IRR rate. So cash inflows at year one, company will not keep idle with itself. It will reinvest somewhere. So IRR assumes that such reinvestment would happen at IRR rate. So modified IRR solved its problem. Modified IRR says the cash inflows that are generated every year are reinvested at your discounting rate or at your required rate, not at IRR. IRR rate gives you the maximum earning capacity rate of the project. Whereas modified IRR says that the cash inflows that are generated each year, the company obviously will not keep idle with itself. It will reinvest somewhere so that the return, the wealth is maximized. So at which rate it can reinvest? So it will be reinvested at the discounting rate. And discounting rate is nothing but the desired rate, the expected rate. Hope everyone is understanding. So what is MIRR? MIRR is that discounting rate. MIRR is discounting rate where present value of terminal cash inflows is equal to present value of cash outflow. Focus on this word terminal. Huh? This is the difference between IRR and MIRR. IRR is simple, that discounting rate where PVCI is equal to PVCO. But MIRR is that discounting rate where PV of terminal cash inflows. What do you mean by terminal cash inflows? What do you mean by terminal cash inflows? Bolo. Reinvestment rate issue. Yeah, Swati is correct. The difference between IRR and MIRR is about reinvestment rate issue that we have discussed just now. But what do you mean by present value of terminal cash inflows? See, under MIRR, what we have learned, we calculate the cash inflows per year. Then we make a pool of cash inflows at the end of the project year or at the end of the life of the project. We used to create a pool of all the cash inflows at the end of the project life. And that pool of cash inflows at the end of project life is called terminal cash inflows. Terminal means at the end of project life. So what we used to do in MIRR, we used to first calculate cash inflows per year. Then using time value of money, we used to create a pool of cash inflows of all the years at the end of the project's life. And the present value of that pooled cash inflow is called present value of terminal cash inflows. Are you understanding? See, this technique you have learned already. Yes, and at the end of the, not at the end of the year, at the end of the project's life. So at the end of last year of the project's life. Correct? We used to create a pool of cash inflows at the end of project's life, and discounting and calculating the present value of that pooled cash inflow is called present value of cash inflows. So the discounting rate where present value of such pooled cash inflow is equal to PBCO is my modified IRR. Understood? Apart from this, you have also learned that there are certain situations where NPV technique and IRR technique will give conflicting results. We have also learned 3 situations where NPV and IRR will give contradictory results. What do you mean by contradictory results? Let's say under NPV technique, my project A is selected because it has higher NPV. And let's say under as per IRR technique, project B is my selection criteria because it has higher IRR rate. So this is called contradictory results. One technique is giving different result, another technique is giving different results. Are you understanding this? So what are the situations where NPV and IRR will give conflicting results? So situation number 1 is when the size of the projects, when the size of 2 projects are different. Situation 1 was size of both the projects are different. So in that case, you will get contradictory result. Let's say project A is of 2 lakh, whereas project B is of 20 lakhs. So both this project or both this technique would give you a contradictory answer. Second is timing of the cash flows. Timing of generating the cash inflows. One project generates cash inflows at initial stage. One project generates substantial proportion of cash inflows at very initial stage, whereas another project generates maximum proportion of cash flows at the later stage of its life. So under such situation also you will get a contradictory result between both this technique. And C, last but not the least, unequal life of the project. Unequal life of the project. When the life of both this project, let's say project A and project B, life of project A is 3 years, life of project B is 6 years. So under that situation as well, both the techniques NPV and IRR will give contradictory results. However, our focus, if in examination you have been asked to select one of the projects, then your weightage should be on NPV because it maximizes the wealth of the shareholder and not IRR. Okay? However, if you are asked to choose between NPV and IRR, always rely on NPV because it maximizes the wealth of shareholders. But just for your quick revision, these are the 3 situations where NPV and IRR will give contradictory or conflicting results. Okay? This also you have learned, and this for all this situation, we have one illustration in module as well. So you can check or you can solve those illustrations for your better understanding. Bolo, any queries still here? Students, any doubt? Any questions? Sukana, MIRR is not clear. Okay, if time permits, we will solve a question on MIRR as well so that it gets clear to you. But only difference between IRR and MIRR is that under MIRR technique, we create a pool of cash inflows. Pool means we accumulate all the cash inflows at the end of the project's life. Let's say cash inflow for year 1. Let's say company has generated cash inflow for year 1, which is 1 lakh rupees. And the life of the project is 5 years. Okay? So this 1 lakh, can I say it will be reinvested for another 4 years? This is first year and the life of the project ends at 5th year. So can I say this 1 lakh will be reinvested again for 4 years? So 1 lakh ka at the end of 5th year kitna hoga? That is the pool of cash inflow. Are you getting this? So 1 lakh will be reinvested for this further 4 years at a discounting rate at your KO. So let's say if your KO is 12%. So can I say 1 lakh after 4 years will become 1 lakh plus 12% plus 12% plus 12% plus 12%. So are you following? 1 lakh is reinvested at 12% for 4 years. So can I say 1 lakh ka ho jayega 1 lakh plus 12% one time plus 12% second year plus 12% third year plus 12% fourth year. So this is called as pool of cash inflows. We are creating a pool at the end of the life. And then we calculate the present value of this pooled cash inflow. But you will understand once you solve a problem or once you take some numbers, you will get better clarity. So we have one illustration for MIRR as well. So if time permits, we can solve that, or else you can revise it by yourself. Okay? Now, to solve this problem, to solve this limitation of unequal life, to solve this problem, we have learned another two techniques where the life of project is unequal. Can I say prima facie it is uncomparable? Project A has a life of 3 years and project B has a life of 15 years. So prima facie, can I say this both the projects are very uncomparable? It cannot be compared because of unequal life. Yes or no? So to solve this problem, we have learned two methods called replacement chain method. We are trying to bring the life equals. Why we are trying to bring the life equal? To compare, so that it becomes comparable. The project can now be compared. So for that, we have used replacement chain method. We learned about replacement chain method. And second was equivalent annualized criteria. Second was equivalent annualized criteria. What was equivalent annualized criteria? It was nothing but NPV of the project divided by present value annuity factor of that project. This was the formula to solve equivalent annualized criteria. Yes or no? So when the life of the projects are unequal, so it cannot be compared. Project A has a life of 3 years, B has a life of 15 years. So prima facie, outrightly it cannot be compared. But to make it comparable, to bring the life equal, we have two methods called replacement chain method and equivalent annualized criteria. Replacement chain method means, let's say a project A ka life is 3 years, project B ka life is 6 years. So can I see if I take project A one more time, 3 years, it will match with the life of project B, which is of 6 years. That is called replacement chain method. Taking entire project one more time to match with the life of project B. Project A 3 years, project B 6 years. To match with the life of project B, if I take entirely this project A one more time, can I say now it will match? So now it can be compared. So that is called replacement chain method. But replacement chain method again has its own limitations. What if the life of project A is 7 years and project B is 11 years? So we need to reach it at common multiple. We need to calculate LCM, which comes to 77 years. It means a project which has a life of 7 years needs to be taken 11 times. And project B, which has a life of 11 years, needs to be taken 7 times so that it matches. So can I say the calculations will be very lengthy and tedious process? So that's why we use the second method called equivalent annualized criteria. Understood everyone? So to make the projects comparable, or to match the life of the projects, we have two methods, replacement chain method and equivalent annualized criteria. Okay? Replacement chain method can be sometimes very lengthy and tedious process, because what if the project life of one project is 7 and another is 11? So to match the life, can I say we have to match it at LCM of 77? It means taking project A 11 times and project B 7 times. That is very long process. So for that, we have devised another method called equivalent annualized criteria, and the formula is NPV of the project divided by present value annuity factor. Okay? Again, I am repeating that once you calculate this by taking some numbers, your concepts would be at a very high clarity. So taking numbers, solving problems is very critical part in any practical subjects. Okay? We will take some problems and we will solve as many problems as possible to the maximum extent. Okay? Now, last but not the least, last concept was about capital rationing. Last concept that you would have learned in this chapter is capital rationing. What do you mean by capital rationing? Rationing means constraint, and capital rationing means constraint of funds. कंपनी इज फेसिंग पैसे का इशू. सबके लाइफ में भी यही इशू है, पैसे का इशू ही चल रहा होता है. सो दैट इज कैपिटल रैशनिंग ओनली. जितने भी पैसे आए, हाउ मच वी अर्न, वी फील इट इज लेस ओनली. So we are also under this situation of capital rationing. But here, as far as capital budgeting is concerned, capital rationing means company has many projects for consideration and all the projects have positive NPV. Every project is lucrative, but company does not have funds for investing. Company does not have funds for investing. Okay? So under such situation, how should be our decision making? So we first categorize the projects into two parts. One is divisible projects. Divisible projects. Yes or no? And some projects are indivisible. What do you mean by divisible projects? Divisible project means part of the project is possible. Let's say if you want to take entire project A, it would cost 3 lakh. Let's say if you want to take entire project A, it will cost 3 lakhs. But you just have 2 lakh of funds. So up to 2 lakh of the project you can take. That is called part project. Part project is possible. If you have 2 lakh, if you want to take entire project, then you would need 3 lakh. But since you have fund constraints, you only have 2 lakh of rupees. So take 2/3 of the project. Don't take entire project. That is called divisible project. Are you getting this? Part project is possible. And what do you mean by indivisible? You have to take the project entirely. You have to take the project entirely. In other words, if project A cost 3 lakhs and if you don't have 3 lakhs of funds, then you just cannot take this project. This is what indivisible project means. Even though if you have 2 lakh of funds, but you need 3 lakh for investment, since the project is indivisible, you will not be able to take the project. So indivisible means lena ho to pura lo. Divisible means part, tukda is possible. Understood? Understood? So when the projects were indivisible, can I say our decision making was based on NPV per rupee of investment, per rupee of initial investment? Yes or no? NPV per rupee of initial investment means the formula was NPV of the project divided by initial investment amount. And when the projects were indivisible, then our decision making was purely based on NPV technique. In other words, take those projects which have higher NPV. You give ranking of the projects based on their NPV. More the NPV, higher the rankings. जैसे more the marks, higher the rank of the student. वैसे ही more the NPV, higher the NPV, higher the rankings. And under divisible projects, our ranking was based on NPV per rupee of investment made. ठीक है, per rupee of initial investment made. Bolo, any queries till now? We have just quickly, not quickly, but we have gone through all the concepts without taking numbers as of now. But are you able to connect? Are you able to like get through what we have done till now? Now we will take some practical problems so that you get more clarity on it. Okay. Okay. So we have revised all the substantial concepts of this chapter. So now let's take some practical problem. Let's start with practical problem number 1. Following data has been available for a capital project. Annual cash inflows 1 lakh rupees. Life is 4 years. Salvage is nil. IRR is given 12%. Profitability index is 1.064. You are required to calculate cost of project, cost of capital, NPV and payback period. Okay? So this question is like a treasure hunt game. Treasure hunt game that we used to play in our childhood. From one hint, we used to find another clue. From another clue to third clue, third to fourth clue, and then we would reach at our final destination. वैसे ही इसमें भी हमें वही प्रोसेस अपनाना है. First is they are asking about cost of project. Means can I say they are asking about initial investment or original cost? Yes or no? See, I have IRR rate. I have IRR rate and I have inflows. So can I say IRR? Using IRR, I can somehow find initial investment or original cost. Yes or no? Because IRR is that rate. IRR is that rate where PVCI is equal to PVCO. We are solving practical problem number 1. Okay? And in that we are calculating first part, cost of project. Cost of project. It is nothing but my initial investment. So when I said IRR, IRR is that discounting rate where PVCI is equal to PVCO. Yes or no? At IRR, PVCI would be PVCO. Yes or no? So my IRR is given at 12%. So I can easily calculate present value of cash inflows. Correct? Are you getting this? My IRR is 12%. So can I say using this discounting factors, I can calculate present value of cash inflows, and that present value will be my cash outflow, will be my initial investment. So can you please calculate this? My cash inflow is 1 lakh. So 1 lakh multiply by the PVAF factors. बोलो कितना आ रहा है? Let me bring my calcium. Let me bring my calcium. Yeah, I hope you are understanding the process. So Om Prakash, only Om Prakash has solved 303800. So when I say it is nothing but 1 lakh into We will first calculate the PVAF factor. PVAF factor is nothing but summation, cumulation of all the discounting factors. So 0.893 plus 0.797 plus 0.712 plus 0.636. So it comes to 3.038. So can I say my PVCI is equal to 1 lakh into 3.038, which comes to 303,800. And at IRR, my PVCI is always equal to PVCO. So can I say, in other words, my initial investment or my original cost of project will be 303,800. Yes or no? Bolo, any questions? Any doubt in first part? Yes, Swati, you are also correct. Any doubts? Any questions? Can we move to next part? Next part, they have asked us to calculate cost of capital. Means KO rate they have asked. They have asked to calculate KO. Yes or no? Bolo, how will we solve that? Tell me. Tell me, how will we solve that? Can I say PVCI? Now we will use another clue, that is PVCI. Second is cost of capital, KO. Can I say profitability index is given? Profitability index is nothing but PVCI that divided by PVCO. Correct? Now I have my cost of project with me. Cost of project is 303,800. So can I say I can calculate PVCI? Yes or no? My PVCO is how my profitability index is how much? 1.064. When I say 1.064 is equal to X divided by 303,800, I have already calculated my cost of capital. Not cost of capital, but cost of project. I have already calculated in first part above. So can I say my PVCI comes to 303,800 multiplied by 1.064. So my PVCI comes to rupees 323,243.2. Are you getting this? Bolo, any queries still here, students? Are you following? Any questions? See, I have used profitability index key information. I have just calculated my PVCI. Correct? So my PVCI comes to 323,243.2. Now, my PVCI is nothing but cash inflows per annum multiplied by PVAF factor. Yes or no? So 323,243.2 is nothing but cash inflows per annum are 1 lakh given in the question. I don't know the PVAF factor. So when I say my PVAF factor, present value annuity factor, comes to 3.23432, 3.23232. Yes or no? This is my present value annuity factor. Now we have to just see the question and calculate the summation of all this discounting factor. Whether summation of discounting factor of 11% will give you 3.23432, whether PVAF at 10% will give 3.23432, or whether 9% will give 3.23432. बोलो कौन से रेट पे आ रहा है? कौन से रेट पे प्रेजेंट वैल्यू एन्युटी फैक्टर कम्स एट 3.23432? Can you calculate? 10%. 0.909 at 10%. My PVF is 0.909, 0.826, 0.751 plus 0.683. It comes to 3.169. At 10%, Swati, it comes to 3.169. Calculated 9%, 0.917 plus 0.842 plus 0.772 plus 0.708. 0.708. So approximately at 9% it is coming. At 9% my PVF factor is 3.239. Yes or no? So at 9% my PVAF is equal to 3.239. So my KO would be 9%. My discounting rate would be 9%. Friends, are you following this? ये आपको समझ रहा है कि नहीं? At least respond yes or no. Yes, Shoaib is correct. 9%. Yes. So second part of the problem is solved. Third part, net present value. Again, net present value is nothing but PVCI less PVCO. So second part is solved. KO is at 9%. Third is NPV. And we know NPV is nothing but PVCI less PVCO. My PVCI, I have just calculated in number 2 above. It is how much? 323,243.2. My PVCI is 323,243.2 and PVCO is 303,800. So it is nothing but 323,243.2 minus 303,800. So my NPV comes to 323,243.2 less 303,800. 19,443.2. Correct? 19,443.2. So this is my answer to question number or Roman number 3. Payback period. Fourth is payback period. Payback period means time within which my original investment is getting recovered. Yes or no? And in the present question, my cash inflows per annum are constant. So I can easily use the formula. The formula is nothing but original investment divided by annual cash inflows per annum. Yes or no? So my original investment is 303,800. My cost of project is 303,800 and my annual cash inflows per annum are 1 lakh. So it will take around 3.038 years. ठीक है? समझ रहा है? Any doubts, students, in question number 1 of module? Yes, 3.038 years. So it was easy. Your brain just need to get that strike that you have to use first IRR to calculate cost of project. ये strike होना चाहिए दिमाग को. Done? So now let's move to question number 2. All the practical problems in module are very unique. In itself, it is very unique. Lockwood Limited wants to replace its old machine with a new automatic machine. Okay? What is the project over here? Old machine wants to be replaced with a new machine. Now, there are 2 models available, model A and model B, at the same cost of rupees 5 lakh each. Both the models are available. So new machine, we have model A and we have model B. Replacement is to be done, that is for sure. But it is to be done between model A and model B. We need to choose between model A and model B. Salvage value of old machine is 1 lakh. So can I say my original investment cost is 5 lakh, salvage is 1 lakh. So net original investment would be 4 lakh. for both the machines. The utilities of the existing machines can be used if the company purchases model A. What has been said over here? The utilities of the existing machines can be used if the company purchases model A. Additional cost of utilities to be purchased in this case will be 1 lakh. So if we use model A, can I say 1 lakh additional cost needs to be incurred for additional utilities? Correct? If the company purchases B, then all the utilities will have to be replaced with new utilities costing 2 lakh. Means if company is going for model B, then the cost of additional utilities would be 2 lakh. The salvage value of old utilities will be 0.2 lakh. However, if we are going for model B, then we have to invest 2 lakh of rupees in new utilities, but सामने से हमें 0.2 lakhs means 20,000 we will get scrap of old utilities. Are you getting this? The cash inflows are expected to be as follows. So they have given cash inflows for model A and model B every year. The discounting rate is also given. The targeted return on capital is 15%. So can I say discounting rate is 15%? And they have given discounting factors at 15% as well. Yes or no? You are required to compute for the two machines NPV, discounted payback period, desirability factor. State which of the machine is to be selected. Okay, so we need to see replacement is to be done. Old machine has to be replaced with new machine. But model A के साथ replace करे, model B के साथ replace करे, that we need to decide. Understood? Question, did you follow? So first of all, let's calculate the initial investment. Let's calculate the initial investment for both the machines. Problem 2. This is problem 2. Okay? For model A, let's calculate the initial investment. Calculation of initial investment. Can I say my initial investment would be 5 lakhs of the original cost of the machine? 5 lakhs. Correct? However, the old machine will give me a salvage value of 1 lakh. So can I say my cost will be reduced by 1 lakh because I will sell that old machine. So it will fetch me 1 lakh rupees. Apart from this original investment, there are certain utilities cost that machine A will require. The utilities cost that machine A will require is 1 lakh. So I will add that 1 lakh as well. And in absence of information, this additional utilities will be required at the beginning of the year. Are you getting this? Is everyone following? Zoom the screen. Okay. Now it is clear. So 5 lakh my cost of machine. However, old machine will generate 1 lakh rupees of cash to me. So my net cost of model A is 4 lakh. But model A will require additional utility which will cost me 1 lakh. So my initial investment for model A is how much? 5 lakh rupees. Okay? And this additional utilities will be incurred. The cost of additional utilities will be incurred at the beginning of the period because nothing is mentioned specifically about that. Okay, so my initial investment for model A, it is 5 lakh. Now let's calculate initial investment for model B. For model B, calculation of initial investment for model B. So again, model B is of 5 lakh rupees, correct? And old machine will fetch 1 lakh rupees of salvage. Now model B has an additional utility cost of how much rupees? Model B will have additional new utility cost of 2 lakhs. Correct? But the old utilities will generate some salvage. See here, they have written all the existing utilities have to be replaced. So can I say if I am replacing with the new utilities of 2 lakh, the old utilities is fetching me a scrap of 20,000. So I need to subtract that as well, scrap of old utilities, which will fetch me an amount of 20,000. So in short, if you see my new utilities is costing me 1,80,000 and my new machine of model B is costing me 4 lakh, whereas my new utilities is costing me a net of 180. Okay? So how much is my net initial investment for model B? It is 46 minus 20, 580. 4 plus 2, 6, 580. Did you understand this, friends? How to calculate original investment? Apart from Om Krishna Gupta, only he is responding. Other participants, you can also respond. You are not getting charged for giving response. Okay. So my original investment is for model A, it is 5 lakh, and for model B, it is 580. Now it is very simple. Now you just need to focus on present value of cash inflows. How to calculate present value of cash inflows? You just take the cash inflows each year, multiply it by discounting factor. You just take cash inflows of each year, multiply by the discounting factor. And at the end of 5th year, this machine will have a salvage value as well. Okay? And I hope you know how to calculate present value. Huh? So, working note number 2. Calculation of PVCI. So, for first we will calculate for model A. You just need to take cash inflows each year and multiply it by discounting factors. So, बोलो कितना आ रहा है? For model A, can I say 1 lakh into 0.870 M plus फिर 150 into 0.756 M plus फिर 180 for year 3 into 0.658 M plus 2 lakh into 0.572 M plus 170 into 0.497 M plus, and last but not the least, salvage is also an inflow, 50,000 into 0.497 M plus and MRC. कितना आया PVCI for model A? Students, PVCI comes to how much? 540 to 580, correct. 540 to 580. Similarly, can you calculate for model B? My PVCI comes to how much for model B? Can you calculate that? So again, same thing. You take cash inflows per year of model B and multiply it by discounting rate. So can I say 2 lakh into 0.870 M plus 2 lakh 10 into 0.756 M plus 180 into 0.658 M plus 170 into 0.572 M plus 40 into 0.497 M plus and 60,000 of scrap value multiply by 0.497 M plus MRC. कितना आया? 598,140, correct. 598,140. So I have my PVCI and I have my initial investment for both the projects. So can I say I can easily calculate NPV? Working note 1 was calculation of initial investment. Okay. So my NPV for model A is nothing but 542, 580 less 5 lakhs, which comes to 42,580. And NPV for model B is 598,140 less original investment of model B was 5,80,000. Yes or no? So which comes to 18,140, my NPV. Any queries? Yes, Swati, correct. So now I have PVCI and now I have PVCO. I can easily calculate profitability index as well. Yes or no? I can easily calculate profitability index as well, because they have asked desirability factor as well. See, desirability factor is nothing but profitability index. So can I say my PI, profitability index for model A, is nothing but 540 to 580 divided by 5 lakh, which comes to 1.08516, 1.0851. And my PI for model B will come to 598,140 divided by 580. 598,140 divided by 580. कितना आ रहा है? 1.03127. 1.031213. Sorry. So when I say as per NPV model and as per PI technique, machine A or model A needs to be selected because it has higher NPV and higher PI. Are you getting this? Last but not the least, they have also asked about discounted payback period. So how do we calculate discounted payback period? Working note 3, calculation of discounted payback period. So for discounted payback period, we will first prepare a column of cumulation of cash in. We will first calculate the present value and then we will prepare a column of cumulative cash inflows. So my cash inflow column, then present value of cash inflow column, then accumulation column. So this is year 1, 2, 3, 4 and 5. My cash inflows for model A. Let's first solve for model A. For model B, you can solve it as a homework. We'll just solve it for machine A in class and we will move to next question. For model B, you can solve it as homework. So my cash inflows are 1 lakh, 150, 180, 2 lakh, 1 lakh, 150, 180, 2 lakh, and 170 plus 50, 2 lakh 20 at the end of year 5th. It is nothing but 170 plus 50 of scrap. Okay? Present value. So when I say to calculate present value of this cash inflow, I just need to multiply it by the discounting factors of each year. So 1 lakh into 0.870, 87,000. 150 into 0.756, 113,400. 180 into 0.658, 118,440. 2 lakh into 0.572, 114,400. And 220 into 0.497, 109,340. Okay? Now we prepare a accumulation or we do summation of this table of PVCI. Okay? So my accumulation would be 87,000, then 87,000 plus 113,400. So my accumulation, so my cash inflows till the end of year 2 is 2,04,000 plus 118,440. So it will come to 318,840 plus 114,400. It will come to 433,240 and plus 109,340, 542,580. Correct. So we have prepared accumulation table. Now my original cost. See what is payback period? Recovering your original cost. Recovering your original cost. So can I say it will be somewhere between year 4 and 5? Yes or no? Because my original, if you see this table, if you see the accumulation table, till the end of year 4, I am able to recover only 433,240. But till the end of year 5, I am able to recover 540 to 580. But I want to recover how much? 5 lakh rupees. So can I say it will fall somewhere between year 4 and 5? Yes or no? Yes or no? Correct? So my discounted payback period is for sure 4 plus something. It is for sure 4 plus something. Now we need to calculate what is that something. So can I say in the entire 1 year period between 4 and 5, in the entire 1 year period between year 4 and 5, my company is able to earn how much of PVCI? Can I say it is 109,340? Yes or no? It was able to earn between year 4 and 5 a cash inflow of rupees 109,340 in present value terms. But I just want to recover how much? I just see till the end of year 4 I am able to recover 433,240. So it is something less than 5 lakh. But till the end of year 5 I was able to recover 540 to 580. So it is much more than 5 lakh. So can I say between year 4 and 5, I just want to recover, can I say 66,760? Yes or no? कैसे आया 66,760? तो it is nothing but 5 lakh minus 433,240. In the entire 1 year, I am able to recover 109,340. But additional, I just want to recover 66,760. Why? Because I want to reach till here. I want to reach at 5 lakh. I want to reach at 5 lakh. So how much time period it will be needed? That is discounted payback period. So when I say it is nothing but 66,760 divided by 109,340. It comes to 0.6105. Yes or no? 0.6105. Something around 0.6105. So when I say this something is nothing but 0.6105, my discounted payback period is 4.6105 years. I hope you are understanding how to calculate discounted payback period. Again, I am repeating, till the end of year 4, I am just able to recover 433,240. I want to recover 5 lakh. So can I say year 4 cannot be my discounted payback period? It has to be something more than year 4. Now till the end of year 5, I am able to recover 540 to 580. It means extra 40 to 580 I am able to recover. So when I say my payback period also cannot be year 5, because it is generating or it is recovering 540 to 580. So it has to be something less than 5 years. So my discounted payback period is something or somewhere between year 4 and 5. Now let's check what is that something. Now let's calculate what is that something. So we use interpolation method. What is that interpolation method? In the entire 1 year period, of 4 and 5, between 4 and 5, I am able to earn 109,340. I am able to earn additional cash inflows of 109,340. But I just need additional cash inflow of 66,760 only. Why? Because I want to reach at 5 lakh. I don't want to reach at this point. So how much time will be required? How much time will be required to earn this additional 66,760? It is 0.6105. तो कैसे आया? इंटरपोलेशन. You cross multiply 66,760 multiply by 1 divide by 109,340. Followed everyone? Any questions? Bolo. Any doubt? Shoaib is clear. Apart from Shoaib, there are, I guess, another 14-15 participants. So is everyone clear with question 2? Yes. So this technique is called interpolation. Huh? This is the logic of discounted payback period. Cross multiplication. So we have done with question 2. Now for model B, calculate discounted payback period for model B in homework. Huh? You please solve it by yourself for model B in homework. Okay. Let's move to question number 3. Hind Liver is considering a new product line to supplement its range of products. So now the project is launching a new product. As I said, that project, the word project has very broad meaning. In earlier question, it was replacing old machine with new one. Here, it is launching a new product. It is anticipated that the new product line will involve cash investment of 7 lakh at time 0 and 10 lakh in year 1. So can I say we have to discount cash outflow of 10 lakh in year 1 as well to bring in present value terms? After tax cash inflows of 2,50,000 are expected in year 2. See, please mark it here very carefully. The cash inflows are beginning from year 2 and not from year 1. So year 250 will be multiplied by the discounting rate of year 2 and not year 1. Students here generally do mistake. That's why I'm focusing on this point. It is starting from year 2. 3 lakh in year 3, 350 in year 4 and 4 lakh each thereafter through 10 years. Although the product line might be viable even after year 10, the company prefers to be preservative and all the calculations at that time. Okay? Means in short, the life of the project is 10 years for our calculation purpose. If the required rate is 15%, compute NPV of the project and whether it is acceptable or not, advise that. So if NPV is positive, it is acceptable. If NPV is negative, it is to be rejected. Okay? So let's calculate part A of problem 3. Problem number 3. First, calculation of NPV when discounting rate, when my KO is equal to 15%. Okay? So when I say NPV is nothing but PVCI less PVCO. Correct? So first we will calculate PVCI. My PVCI. Again we will use cash inflows. PVCI is nothing but discounting of future cash inflows. Yes or no? So my PVCI is nothing but my cash inflows are 250 in year 2. So 250 divided by 1.15 divided by 1.15 and raised to 2 and raised to 2. This is raised to ka sign because cash inflows are generating from year 2 and not from year 1. Plus for year 3 it is 3 lakh. So 3 lakh divided by 1.15 raised to 3 plus 350 in year 4. 350 divided by 1.15 raised to 4 plus 4 lakh each year through year 10 means now from year 5 it is constant at 4 lakh divided by 1.15 raised to 5 and so on till year 10. 4 lakh divided by 1.15 raised to 10. ठीक है? ठीक है? So can you just help me in calculating PVCI of the project? What is my total PVCI coming? I hope you know how to solve this in directly in Calci. You know the technique in Calci, right? Oh, Om Krishna has solved for model B as well. Good, nice. So almost discounted payback period for both the models is almost same. Friends, please calculate PVCI. Please calculate PVCI for the project. Data is given in the question. You just need to apply the discounting rate or you just need to directly solve in Calci. I hope you know the technique. 250 divided by 1.15. Since it is raised to 2, you press equal to 2 times. Okay? Then 3 lakh divided by 1.15. Since it is raised to 3, you press equal to 3 times. Then 350 divided by 1.15. Press equal to 4 times. Please help me in finding or calculating the total PVCI. 818. See, right now we are calculating cash inflows. Currently, we are just calculating PVCI. So our working note 1 is about calculation of PVCI. Then through working note 2, we will separately calculate PVCO. If you want to directly calculate with PVCN, then also it is fine. But my process or my way of solving is using 2 different notes for 2 different variables. Calculation of PVCO. PVCO will be my initial investment is 7 lakh in year 0. So 7 lakh divided by 1 since it is year 0 and additional investment of 10 lakh. 10 lakh divided by 1.15 raised to 1. What is my total PVCI coming? You can calculate this. 1451,800. 1451,800. You can check with the solution as well. PVCI is 189. 1451 800. Yes, correct. So my PVCI 1451 800 and my PVCO comes to 7 lakh 10 plus 10 lakh divided by 1.15. कितना आ रहा है 15. What is my PVCO? Can we take from year to directly, sir? Means what do you want to take from year to? We have also taken from year to directly. Year to से लिया ना inflows. We have taken inflows from year to only. 1569,565. So 1569. It is around 1569,565. 560. So when I say my NPV would be 1451 800 less 1569 560. So it comes in negative, huh? It comes in negative 1570 आसपास. Okay. If you have taken up to 3 decimals, then it will come exactly at 1570. If you are taking entire decimals, all the decimals, then it will be around 1569 565. So that is okay, no worries. Yes, rounding off is also correct, but I would suggest you solve up to at least 4 decimals. If not all the decimals, then at least up to 4 decimals. So negative 117,760. So at 15%, since my NPV is negative, tell me, will we accept the project or reject? A negative NPV. Shall we accept the project or reject the project? Reject, yes, reject. NL Shravani, what was your question? I didn't get. We have taken cash inflows from year to only. Reject. So now, can you all solve part B? The part B, under part B, you just need to take cost of capital at 10% instead of 15%. You just need to calculate that. So can you please everyone solve NPV when discounting rate is 10% so that I can explain you part 3 IRR. Everyone please try solving NPV when discounting rate is 10%. Everyone please try at 10%. You can take up to 4 decimals. Or you can consider all the decimals as well. Kiran got, this is PVCI or PVCO or NPV. What is this figure, Kiran? 1860, I guess it would be PVCI. Yes, okay. 1860. And what is NPV at 10%? How much is NPV at 10%? What is this? 1609090000. Vague figure. Kiran, please check your, 16 lakh 9,000. Okay. You are trying to say 16 lakh 9,000. Okay. So NPV is 251, 850 at 10%. Positive. Everyone, did you get this answer? I'm waiting for all of the students. सबको आया 251 850, not exactly 251 850 but near about this figure. There might be some variation due to round of difference. Okay, 251 440. Now third part is IRR. IRR, can I say IRR is that rate where it is that rate where NPV is 0? So ideally it cannot be at 10% because NPV is coming at positive 251. Also IRR cannot be 15% because NPV is coming at negative 117,760. So can I say it is not 10% and 15%, but it is somewhere between 10 and 15. How? Because NPV 0 would lie somewhere between 251 850 positive and 117 760 negative. Correct? So it is somewhere between 10 and 15%. That is for sure. Hope everyone is understanding. Now again, we will do interpolation. Again, we will do interpolation. If you remember the formula of IRR, then well and good, we can directly solve with formula. If you don't remember the formula of IRR, then we can use interpolation. How interpolation will work? Can I say increase of 5% rate from 10 to 15%? My IRR decreased from 251 850 to negative 117 760. Are you getting this? Increase in rate of 5%. Increase in 5% is resulting into decrease in NPV by how much? Decrease in NPV by how much? Can I say 251 850 plus 117 760? It is result in decrease of NPV by 369 610. Sir, कैसे 369 610? See, positive 251 850 says 0 and further it is decreasing by 117. So net decrease is of 369 610. Are you getting this? However, I don't want my NPV to fall by 369. I just want that if my NPV falls by 251 850, it will be at 0. Are you getting this? I just want my NPV to fall by this amount, by 251 850 only. I want to fall my NPV only by NPV by 251,850. So how much rate I need to increase? This is again interpolation technique. So when I say it is nothing but 251,850 multiply by 5 divided by 369,610. It comes to 1 point. It is nothing but 10% plus 251,850 multiply by 5 and the whole divide by 117,760. So it comes to 1.41. So my IRR is nothing but 11.41%. Hope you all understood this. 3.4 RI. Okay, it is 3.4. So my calci is showing 1.4 to me. 251 into 251,850 into 5 divided by 117,760. 251,850 multiply by 5 divided by 1177. Sorry, divided by, it is not 117 but 369,610. 369. We are just cross multiplying. 251,850 multiply by 5 divided by 369,610. 3.4. Yes, it comes to 3.4. So 13.41 is my IRR. Correct? Everyone? Bolo, any questions in IRR? And we can use this formula as well. Huh? We can use this formula as well. Formula of IRR is lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate, the whole multiply by higher rate minus lower rate. Okay? So NPV at lower rate comes to 251,450. NPV at again lower rate is 251,450 minus NPV at higher rate. Higher rate is 15%. So at 15%, my NPV was around 117,760. Higher rate minus lower rate. Okay? And likewise, you can also calculate payback period. Payback period is just recovering your investment amount. So here the investment amount is 17 lakhs. Huh? It is 17 lakhs and not 7 lakhs. Okay? So by payback period in that case comes to 6 years. Followed everyone? Followed? Now let's take one problem which is, I feel, very important because it is based on incremental approach. It is based on incremental approach. Let's solve one illustration. Illustration number 80. It is a very good question according to me. It is on incremental analysis. It is on incremental approach. HMR Limited is considering replacing a manually operated old machine with new automatic machine. So currently we are having old machine, but that old machine is manually being operated. But now we want a new machine which is completely automatic. The old machine had been fully depreciated for tax purpose, but has a book value of 240 as on 31st March. See, old machine has been fully depreciated for tax purpose means now there is no tax shield left as far as old machine is concerned, because for tax point of view, old machine is valued at zero as far as tax point of view is concerned. Means tax, now old machine will not generate any tax shield. It will not give any tax shield to us. Depreciation of old machine will not generate any tax shield. The machine has begun causing problems with breakdowns and cannot fetch more than 30,000 if sold in the market at present. Okay? So if right now if we go in the market to sell this machine, then no one is ready to give 30,000. It will have no realizable value after 10 years. The company has been offered 1 lakh for the old machine, but as a trade-in on the new machine, which has a price of 450. So, however, here they have clearly said that if our company wants to buy a new machine, so it will cost 4,50,000, but we will get value of old machine of at rupees 1 lakh. Means if we buy new machine of 450, we will get value of 1 lakh for old machine. So our net cost would be at 3,50,000. Hope you are understanding this. The market value is 30,000, but we would have found some greater deal. Our negotiation skills would have been better in that case. So company is ready, or company is being offered 1 lakh for old machine. Although the market price is 30,000. Now that is irrelevant for us. हमें कितना प्राइस मिलेगा फॉर ओल्ड मशीन, वी आर रेलेवेंट, और इट इज रेलेवेंट फॉर अस दैट हमें कितना मिल रहा है, कंपनी को कितना मिल रहा है. द एक्सपेक्टेड लाइफ ऑफ द न्यू मशीन इज 10 years with salvage value of 35,000. Further, the machine follows straight line depreciation method, but for tax purpose, WDV method of 7.5% is considered. See, this is very important. Company follows straight line method. So this is from accounting perspective. But for tax purpose, WDV is used. आपने taxation में देखा होगा, when we calculate the total computation of income, or when we calculate PGBP income, we first add depreciation as per books and then we subtract depreciation as per tax basis. Correct? So वही है यहाँ पे. Company is following SLM as per books, but as far as taxation is concerned, we are following WDV method. So we are more concerned here with this rate and not with SLM rate. Okay? Given below are the expected sales and costs from both old and new machine. So these are the expected sales and cost of old machine. These are expected sales and cost for new machine. Tax rate is per 30% and this PAT is calculated. Now my question to you, is this PAT as per books or as per taxation? Tell me. Is this PAT as per books or as per taxation? Bolo. What is your opinion? What is your view? Is this profit after tax as per books of accounts or as per taxation? As per income tax? क्या है बताओ? As per books, correct. As per books, yes, correct. Because see, for taxation purpose, old machine is completely written off. So there would not be any depreciation over here. If had this been my profit after tax as per taxation, so for old machine there would not be any depreciation amount, because old machine is completely depreciated or it is nil for taxation purpose. But here it is 24,000. It means it is nothing but book value of 240 and the life of 10 years. Divide by 10. So this is SLM depreciation. And another end that company follows SLM, it is as per books. So these figures are as per books, correct? Okay. So can I say my incremental, how much would be my incremental sales if I have replaced the old machine with new machine? Here in the question, they have asked whether the old machine should be replaced or not. So whenever replacement decision is to be made, you follow incremental approach. This is a standard rule. Whenever replacement decisions are asked in the question, you follow incremental approach or you follow incremental analysis. And what do you mean by incremental analysis? Only the additional benefit and cost that new machine brings, we have to consider that. Only the additional benefit and cost that this new machine brings, we have to just consider that. Incremental means additional. So can I say this is illustration 18. Illustration 18. Illustration 18. ठीक है? Old machine. If my old machine is considered, my net income before depreciation and tax would be by NPBDT would be how much? Can I say it is nothing but 8,10,000 of sales? Yes or no? Less 180,000 of material cost, less 1,35,000 of labor cost, less 56,250 of variable overheads, and less 90,000 of fixed overheads. Can I say my net profit before depreciation and tax, if old machine was continued in the business, it would be 348,750. Hey, any queries still here? This question is very important. It is little complex as well. So we will go step by step. At each step, I will ask you whether you have any doubts, any questions. And if it is clear to you all, we will move forward. Bolo, any queries still here? No queries, okay? Similarly, let's calculate NPBDT had the old machine been replaced with new machine. Had the old machine been replaced with new machine. So my NPBDT would be, can I say 8,10,000 minus 126,250? 8,10,000 minus 126,250 less 1,10,000 less 47,500 of variable overhead and less 97,500 of fixed overheads. Correct? Kitna aaya? It is 428,750. Yes or no? 428,750. 428,750. So my incremental NPBDT by taking the new machine or by replacing the old machine with new machine, how much additional NPBDT I am able to generate? How much additional benefit I am getting? It is 80,000. Correct? Follow. Any queries still here? Any queries? Any queries? Step 3 is done. Any queries? No queries still here. Okay, everyone is clear. So now let's calculate, let's start from incremental NPBDT and let's reach till incremental cash flows using our standard format. Incremental NPBDT. ठीक है? From this, can I say we will subtract incremental depreciation? Yes or no? The incremental depreciation. So I will get incremental profit before tax. Incremental NPBT. From this, I will subtract tax. From this, I will subtract tax. So can I say I will get incremental NPAT? Incremental NPAT. And to this, if I add depreciation back, if I add back the depreciation, can I say I will get incremental cash flows, cash inflows? Yes or no? Bolo, any doubts in this format? Any doubts in this format? Still, we have not mentioned any figures over here. We have not mentioned any figures, but format is clear to you all. I'm again waiting at this top. Okay, clear. Let's move ahead now. When I say incremental NPBT, it is same for all the years. 80,000, 80,000 for year 2, 80,000 for year 3, 80,000 for year 4, 5, 6, 7, 8, 9, 10. 8, 9, and 10. Correct? Now, what is my incremental depreciation? Let's come to incremental depreciation. Let's come to incremental depreciation. Can I say incremental depreciation is nothing but depreciation for old machine and depreciation for new machine, but as per taxation purpose? As per taxation purpose, a yes or no? Are you understanding what is incremental depreciation? It is nothing but incremental depreciation is nothing but depreciation for old machine less depreciation for new machine. Yes or no? But not as per books, as per taxation purpose, because we are calculating cash inflows, and for cash inflows we are more concerned with depreciation as per income tax purpose. Any queries still here? Any queries still here? Bolo. So can I say depreciation for old machine as per taxation is 0? Why? Because it has already been written off. Now it does not hold any value. So there is no tax shield on depreciation as far as old machine is concerned. Correct? And depreciation for new machine would be the cost of new machine multiplied by the depreciation rate, which is 7.5%. So when I say my cost of new machine is nothing but 4,50,000 of original cost less sale value of old machine, which is 1 lakh. Yeah, are you getting this? So my new machine ka depreciation is nothing but 350 pe 7.5% for year 1. Are you getting this? So 350 into 7.5%. It comes to 26,250. So can I say my incremental depreciation for year 1 would be 26,250? Yes or no? Did you understand this? How incremental depreciation is calculated? Om Krishna is clear. Other participants, did you understand how incremental depreciation is calculated? Incremental means additional or differential. So when I say for old machine, depreciation for taxation purpose would be 0. Why? Because it has already been written off as far as taxation purpose is concerned. This is clearly mentioned in line number 2. It has been fully depreciated for tax purpose. And depreciation for new machine is nothing but cost multiplied by the rate. So 350 multiplied by 7.5. But sir, why 350? The cost is 450. But can I say 1 lakh I will receive as a trade-in for the old machine? I would have sold that machine. So my net cost is 350 only. Correct? So now see. Now this is 26,250 for year 1. Correct? 26,250 for year 1. Now incremental depreciation for year 2 would be, you subtract 7.5% from this 26,250. Take 26,250 on calci, subtract minus, like do minus 7.5%. कितना है? 24,281.5 आया. Everyone 24,281.5. Is everyone following? Now for year 3, you again subtract 7.5% from this 24,281.5. So 24,281.5 minus 7.5%. So when I say it comes to 22,460.39 for year 3, again subtract 7.5%. It comes to how much? Bolo, for year 4. For year 4 it comes to how much? कितना आ रहा है? 2675.64. ठीक है? So you keep on subtracting for all the years. ठीक है? Likewise for year 5, for year 6, 7, 8, 9, 10. Now, so my incremental NPBT for year 1 would be 80,000 minus 26,250. Can I say it comes to 53,750? Tax is at 30%. So minus 30%. So can I say my NPAT, incremental NPAT would be 37,625. And if I add depreciation back of 26,250, so my incremental cash inflow for year 1 is 63,875. Everyone following? Everyone following? So by replacing the old machine with new machine, my new machine is generating additional cash inflows of 63,875. So it is bringing additional benefit of 63,875 in year 1. This is how you interpret incremental cash inflows. बोलो यहाँ तक कोई query? If this is solved, then now it is very simple. Now you have to just replicate for year 1 till year 10. Swati is clear. Okay. All the participants, I hope everyone is clear with this fact. So for year 1 it is 63,750. Likewise, let's check for other years. Illustration number 18. Huh? So आ गया cash inflow 63,875 for year 1. 63,875 for year 1. See, they have used vertical way of solving. We have followed horizontal way of solving. It is one and the same. 63,875. Likewise, you can calculate, see the depreciation, incremental depreciation for year 2 is 24,281. 24,281.5. For year 3, it is 22,460. For year 4, 26,75. It is 775. 775.6. Correct? So, likewise, just as we did for year 1, we can calculate incremental cash inflows for all the year. Okay? Likewise, we can solve it for all the years. Now, apart from this, can I say there would be a salvage value of 35,000 as well at the year 10? Yes or no? If we are replacing this new machine to the old machine, my new machine will generate salvage value of 35,000 at year 10. So I need to add that as well in year 10. So add salvage. Salvage will be added in year 10. Huh? It will be just added in year 10. 35,000. Correct? Bolo. Any doubts still here? Any doubts still here? Once this is done, then we just multiply each year ka cash inflow with discounting factor. And what is the discounting rate given in the question? Discounting rate is 10%. We have to use a discounting rate of 10%. Okay? So once incremental cash inflows and salvage is done, you just multiply each year ka incremental cash inflow with 10%. When I say it is 0.909, 0.826 for year 2, 0.751 for year 3, and so on. So my PVCI for year 1 would be 63,875 into 0.909. 58,062.375. This is for year 1, and likewise for all the years you need to calculate. Bolo, any questions? I just explained you the concepts and the way of solving. Now you need to complete this table. Your task is to complete this table. You need to complete this entire table, but I just explained you the way of solving, how you need to approach. So can you calculate? Sir, I have a doubt in about depreciation. What depreciation doubt you have? Can you type over here? Can you type your query? Yes, but what query you have in that paper? I don't remember all the questions of all the paper. What query you have, you need to type that, na? Apart from Shoaib, any queries to other participants in today's session? Did you understand all the concepts and did you understand all the problems that we solved today? I hope it added some values to your learnings. You can complete this table in the homework. And once PVCI is done, then you just subtract PVCO, present value of initial outflow, and you will get NPV. So if incremental NPV is positive, you accept the project, and if incremental NPV is negative, you reject the project. Okay? So we have 2 minutes. We can try to solve as many MCQs as possible. A capital budgeting technique which does not require the computation of cost of capital for decision making. Which of these 4 techniques does not require KO? Which does not require discounting rate, in other words? Bolo. A, B, C, D. D, obviously payback period, because it ignores time value of money. So it is B. If 2 alternative proposals are such that acceptance of one shall exclude the possibility of acceptance of another, then such decision will lead to ABCD. Batao. Are these mutually exclusive decision, accept, reject decision, contingent decision? See, mutually exclusive decision means you have various projects under consideration, but selection of one project will lead to rejections of another. It means from all the projects, you just need to select one of them. So can I say this is what the question is being asked over here? If 2 alternatives proposal are such that acceptance of one will result into rejection of another. So can I say they are mutually exclusive decisions? They are mutually exclusive projects. correct? Accept reject decision is what? You have all the projects with positive NPV, then all the project will be accepted. This is what accept reject decision means. All the project has negative NPV, then all the project would be rejected. If there are 10 projects under consideration, 5 has positive NPV, 5 has negative NPV, then 5 would be accepted, 5 would be rejected. This is what accept reject decision means. Mutually exclusive means if there are 10 projects under consideration, only one has to be selected. So that one would be selected which has higher NPV. Are you following, students? Difference between mutually exclusive and accept reject. Accept reject में क्या है? All the positive NPV projects will be accepted. All the negative project NPVs will be rejected. But under mutually exclusive, you have to just select one of them. Even though all the projects has positive NPV, you have to just select one of them. So selection of one will result into rejection of others. So that is mutually exclusive. Okay? So with this, let's end today's session. I hope it added or it created some value to you as well. And I hope your all the concepts of investment decisions got revised. Thank you. Thank you for your participation. Next session on investment decision is on 18th of November. In that session, we will try to solve some more practical problems. Thank you. Have a good day.